Welcome back to the deep dive. We've got the latest results from Sundaram Finance Ltd, SFL, in front of us, the unaudited financials for the first half of FY26 up to September 30th.
That's right. And the headline figures are pretty striking.
They really are. Our job today is to, unpack how SFL hit these highest ever disbursement numbers, especially when their own management mentioned macroeconomic sluggishness. Seems like a bit of a contradiction.
It does on the surface. But these results, which the boards signed off on November 3rd after a, pretty thorough meeting, give us the full picture for Q2 in the first half.
So we're looking at the growth, the profits, asset health, and importantly, their compliance, especially around those big NCD fundraisers.
Exactly. It's the whole package, performance and prudence. So where should we start? The growth.
Yeah.
Now let's start there. The press release shouts highest ever.
Yeah.
So how high are we talking for disbursements in the first half?
Okay, so standalone disbursements hit ours. 15,423 crores for H1 FY26. That's a 12% jump from the previous year's ours. 13,768 crores.
12% growth in half a year. That's solid. It is. And it wasn't just a steady climb. They actually picked up the pace.
Oh, really? How did Q2 look specifically?
Well, Q2 FY26 saw disbursements grow 18% year on year. They hit ours, 8,113 crores, up from about ours, 6,860 crores in Q2 last year.
18% acceleration in the second quarter. That suggests they really ramped things up recently. Maybe festival season related?
Could be. Management did hint that a well-planned strategy around that period paid off. It certainly gives them strong momentum heading into the second half.
Okay, more loans going out the door. Did that translate into a bigger overall loan book? What about assets under management, the AUM?
Yep, the AUM kept pace. Standalone AUM grew 15% year on year. It stood at ours, 55,419 crores at the end of September 2025.
15% growth in AUM. So they're booking new business and growing the overall size of their managed assets consistently?
Precisely. It shows the growth isn't just fleeting, it's adding to their core base.
All right, let's talk profit. Profit after tax, PAT. This number really jumped out, a 27% rise in H1 FY26, reaching ours, 823 crores. That's quite a leap for a company this size. What fueled that?
Ah, yes. This is where you need to look closely at the notes. While core operations were strong, operational profit grew a healthy 16%.
Yeah.
The report explicitly attributes that really sharp 27% PAT increase mainly to higher dividend income.
Dividend income, so not purely from their main lending business.
Not purely, no. It suggests a significant contribution, likely from successful subsidiaries. Maybe their asset management or insurance arms had a particularly good payout.
So, while impressive, you have to ask about sustainability, right? Is this a regular thing or more of a one-off boost?
That's the key question for investors, definitely. It polishes the H1 numbers nicely, but it's different from profit generated directly by lending spreads. However, let's be clear, the core lending engine is strong. Their net interest income, NII.
Right, the bread and butter.
Exactly. That grew 23% to ours, 1,603 crores.
Yeah.
So the fundamental business is performing very well. The dividend just added extra fuel to the PAT figure this time.
Got it. Strong core with a dividend kicker. Now, with all this growth, how efficient are they being? Are they keeping costs under control?
Actually, yes. That's another positive sign. Their cost-to-income ratio improved. It dropped to 29.6% in H1 FY26.
Down from what?
Down from 31.91% in H1 FY25. Getting under 30% while growing disbursements by 18%, that shows good operational control.
Lower costs relative to income usually means better returns. Did we see that play out?
We did. Both key return metrics improved. Return on assets, ROA, went up to 2.72% for the half year.
Okay.
And return on equity, ROE, which shareholders watch closely, increased to 15.91%.
So the efficiency gains and the overall growth are translating into better returns on their assets and for shareholders, even accounting for the dividend boost in payout.
Correct. It suggests the increased scale is creating real value. Okay, final check on financial health. Capital, the safety buffer. How's their capital adequacy ratio, CAR, looking? Still comfortable, very comfortable. It stood at 19.3% as of September 30th. TRI capital, the real core stuff, was 16.9%.
That's slightly down from last year, wasn't it? I think it was 20.0%.
It was, yes, a slight dip. But that's pretty normal when a company is expanding its loan book aggressively like this.
Yeah.
They're deploying capital. The key is they are still well above the regulatory requirements. No concerns flagged there.
Right. Okay. So strong growth, good efficiency, solid returns, ample capital. But this brings us to the flip side, risk. When you grow loans that fast,
You have to watch asset quality very closely. And the numbers here do show some, let's say, pressure.
Pressure how? What are the specific metrics telling us? Let's use the Stage 3 asset classification.
Okay. Gross Stage 3 assets, think of these as loans showing significant stress. Typically over 90 days past due, they increased. As of September 30, 2025, the ratio was 2.03%.
Up from what?
Up from 1.62% year earlier in September 2024.
1.62% to 2.03%. That's a noticeable jump, about 41 basis points. Does that suggest the newer loans, the ones driving that record growth, are maybe a bit riskier?
It certainly suggests that. Faster growth often comes with slightly higher risk intake, statistically. You see it reflected also in the net Stage 3 assets, that's after provisions, which rose to 1.13% from 0.89%.
So the actual expected loss on the books is also creeping up. Are they setting aside more money to cover potential losses? What about the provision cover?
This is where they're holding the line. The provision cover remains stable at 45%.
Okay, so even though more loans are slipping into the Stage 3 category, they're maintaining the same percentage buffer against those potential losses.
Exactly. It reflects that stated philosophy, growth with quality. The quality metrics are showing some strain, no doubt, but they haven't reduced their safety cushion. They're acknowledging the higher risk by maintaining the provision level. It's a conscious trade-off, it seems. Grow fast, accept slightly higher gross numbers, but keep the net protected with consistent provisioning. That appears to be the strategy. And just for context, using the older RBI norms, gross NPAs were 2.80% and net NPAs 1.79%, both also up year on year. The trend is consistent across both classifications.
All right, let's zoom out a bit. SFL isn't standalone. It's part of the broader TSF group. The results we're discussing are consolidated, including home finance, asset management, general insurance. How did the whole group perform?
The consolidated picture looks quite solid, too. Group profit after tax grew 11% to Rs, 963 crores for H1. And the total group AUM, combining all the lending and insurance assets under management, reached Rs, 83,586 crores.
Wow, that's a huge number. How much did that grow?
That's up 15% year on year. So consistent growth across the board.
Which parts of the group were pulling the most weight?
Well, Sundaram Home Finance had a strong half. Disbursements up 9%, PD hitting Rs 137 crores, which is a nice jump from R 1111 crores last year.
Okay.
Then you have Sundaram Asset Management. Their AUM is massive, Rs 82,608 crores, and interestingly, 80% of that is in equity funds. Their consolidated profit was Rs 91 crores.
80% equity AUM, that's significant, shows where investors are putting their trust. And the insurance arm, Royal Sundaram.
Royal Sundaram General Insurance also grew its top line. Gross written premium, GWP, increased by 15% to Rs 2,352 crores. Their PATE was slightly down, Rs 121 crores compared to Rs 126 crores, but top-line growth was strong.
So a pretty healthy performance across the major subsidiaries. Now, looking ahead, management acknowledged that initial sluggishness. What are they pointing to now for optimism in the second half of the year?
They flagged a couple of key things boosting sentiment. First, the GST 2.0 reforms. They seem to expect a positive impact from those. And second, the recent sovereign rating upgrade for the country by global agencies.
Right, those were big news items. How do they see that translating into actual business? What's the ND, Rajiv Lokan, forecasting for growth drivers?
The outlook shared is quite optimistic. They're anticipating buoyancy from a few key areas. One, the continued impact of GST 2.0 potentially boosting consumption.
Okay.
Two, better rural demand, especially after what they termed a healthy monsoon season.
Makes sense.
And three, a pickup in private sector capital expenditure CapEx. That's something economists have been waiting for. So they seem positioned to ride a wave of potentially improving domestic economic activity. Interesting. Betting on consumption, rural recovery, and investment pickup. Okay, let's shift to the final piece, regulatory compliance. This can be dry, but it's crucial, especially with debt. They raised a lot via non-convertible debentures, NCDs. A lot. Over $1 billion equivalent just in the last quarter we're looking at. And yes, when you raise that kind of money through private placements, SEBI regulations like 52 and 527A require strict checks on whether the funds were used for the stated purpose.
It's about accountability to those bondholders, right? Making sure the money went where they said it would go.
Exactly. It's fundamental trust and governance.
So what did the regulatory filings say? Did they use the money as planned? The filing was very clear. They stated explicitly, no deviation variation. Okay, a clean slate then.
A clean slate. They detailed the specific tranches Rs 1,000 crore raised on September 11th, fully utilized. Another Rs 500 crore reissued on September 30th, also fully deployed almost immediately. It confirms strong financial discipline. The cash raise was put straight to work as intended.
That's reassuring. Confirms tight controls even when handling massive sums.
Absolutely essential for maintaining market confidence.
Okay, so let's try and wrap this up for you, the listener. What we've seen is Sundaram Finance hitting record disbursement levels, driving strong AUM growth. Profitability looked great, though boosted significantly by dividend income this half.
Right. The core NII growth was solid at 23%, but the 27% PET jump had that dividend kicker.
Efficiency improved, returns are up, capital is ample. But that growth came with a clear uptick in Stage 3 assets, indicating rising risk even though they maintain their provision cover.
It's that growth with quality balancing act in action, the quality side showing some strain under the weight of rapid growth.
And the wider TSF group looks robust, with solid contributions from home finance and asset management. Plus, importantly, they passed the regulatory checks on their large NCV fundraisers with flying colors.
And it's worth remembering, SFL is part of the TSF group, which has been around for a century. That legacy, focused on trust and value, probably informs this measured, if ambitious, approach we're seeing. It's not growth at any cost.
Right.
So here's the final thought to leave you with. Management is optimistic about GST 2.0, rural demand, and CapEx boosting the economy in the second half. At the same time, their risk metrics, like gross Stage 3 assets, were already climbing in the first half. The question is, how will that balance between growth and asset quality play out next? Will the expected economic buoyancy help contain or even improve asset quality despite continued growth, or will pushing for more growth lead to further increases in those risk numbers? Something to watch closely in H2 FY26.